Hello everyone and welcome back to our weekly educational videos. So thanks for attending our webinar and start trading with OneRoyal. A quick disclaimer, the information provided in this webinar is for educational purposes. Please do not take them as a financial advice. Do your own research before start trading or investing. So our topic today is reversal chart patterns. These are the points that we will cover. What are reversal patterns? 6 best known reversal patterns, entry points for those patterns, and how to use these patterns to set our target profits. And finally, we will provide you with live example on MT4. So let's start with what are reversal patterns. Reversal patterns are chart formations that indicate an impending reversal of the current trend. If we look to the right here, we can see that the market was in a clear upward movement, higher high, higher lows. Once we have seen a reversal point or pattern, this might indicate there is a possibility that the direction will shift. So since we are in uptrend, and if you see at the top of the trend a reversal pattern, this might indicate a potential reversal, which will lead, in this case here, to a move to the downside. So lower lows and lower highs. Similarly, if we are talking about a downtrend, lower lows and lower highs, and once the market posts a reversal pattern at the bottom of the trend, let's say double bottom, this is the reversal pattern. This will indicate that there is a possibility of a change of direction, higher lows and higher highs. So in definition, a reversal pattern indicates a shift in direction. Next, what are the 6 best known reversal patterns? We have those 6 patterns here to the right. The first 3, these ones are usually appear in an uptrend. So if you are in uptrend and you encounter one of these patterns, this is an indication that there will be a shift in direction from an uptrend to a downtrend. Similarly, but in the opposite direction, if you are in a downtrend and you encounter one of these patterns, let's say double bottom, this indicates that there will be a move to the upside. So let me clear this chart, sorry, let me clear this PowerPoint. So the first, so yeah, one second, please. So these two are the same and these two are the same, and for sure these two are the same, but it differs. The main difference is the direction. So this one, double top, it has the form of an M, and this means that the market could not close above the previous high. So the market is making higher highs. However, once it reached a certain level, the market could not continue its move to the upside. It will post another double top and then reverse to the downside. So this is an indication that the bulls are weak or the buyers are not powerful anymore to push the market to the upside. So the market posts a double top. Similarly, if we're talking about this, the market is moving to the downside. So we have lower lows, and then it will post a double bottom where the market could not continue below this level. So the market will reverse most probably. An inverse head and shoulders or head and shoulders, let's say what is the meaning behind them. The inverse head and shoulders and the head and shoulders, they have this name because it is made of a head and 2 shoulders. This is mainly why it is called this way. So once you are in an uptrend and you see a first shoulder and then a head and then another shoulder, expect that most probably the market will reverse to the downside. If we're talking about the inverse one, it's the same one but for a downtrend. You'll see something like this: shoulder, another shoulder, 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 head, and then it moves to the upside. Okay, so this is how you will notice these patterns. We will talk about them also on MT4, show you real examples at the end of this session. Wedge, rising wedge, why this will lead to a move to the downside in a case of a wedge, because if you look at this pattern, you can see that the impulsive waves and the peaks are getting so close. So this is an indication that the buyers are getting overwhelmed by sellers, okay, because the market is not moving much to the upside. Instead, we have seen small impulsive waves and the peaks are getting closer to each other, and this indicates a failure of movement to the upside, or the buyers are weak, and you will notice a move to the downside most probably. Similarly, if we are talking about the falling wedge. Next, we will talk about entry points for reversal patterns. Now you understand what is a reversal pattern, what are the common ones. Now I should show you where to enter and where you should put your stop loss. Let's start with the entry point. For the entry point, there are two ways to enter such a trade, either on the break or after a breakout. Okay, so if we're talking about the double top, there is two ways. Either you will enter directly here on the break, or you will wait until the market moves a little bit to the downside and then post a correction to the upside. And then you will enter here based on a sell limit order. Sell limit order. Here you will enter directly here. This is on the break. However, on using a price action confirmation, better to use or to wait until the market go to the downside and then post a small correction or retracement to this neckline. What is the neckline? What is the neckline? The neckline, we can notice the neckline in double top, double bottoms, and head and shoulders, and in inverse head and shoulders. So double top, how to plot your neckline? You will use this low here. By using this low, you will put the neckline, and then this is where you sell under this horizontal line or the neckline. Similarly, if we're talking about the double bottom, you will use this high and you will plot a horizontal line, and this is where you buy. Remember, we have to wait on the break, or we will wait for a confirmation, which means waiting for the market move little bit above the neckline in this case here, and then wait for a retracement, and then buy using a buy limit order. In head and shoulders, to plot your neckline, you should use the lows, two lows, the lows of the shoulders here, and then you will have the neckline. Similarly, here for the inverse head and shoulders, you will use the highs, and you will buy either here on the break, or you will wait for a confirmation after a retracement. Buy limit order here. Here, sell limit order after a confirmation if you would like. In rising wedge, you will use the trend line. So after breaking the trend line, so once the market moves to the downside, either you will the trade based on the entry. You can use as well sell stop order. So you will put your sell stop order here directly after the breakout below the rising wedge, or you will wait for a move to the downside and then you will use the sell limit order. We'll wait for a correction and then you will be filled by a sell limit order. Similarly, here you will wait until the market break the higher end of the wedge or the bearish trend line here. Once this is broken, then you will buy to the upside. So this will shows that there will be a reversal from a downward movement to an upward one. So this is how you plot your this is how you will plot your how do you use the patterns to enter based on these patterns to enter the market. If you want to put your stop loss, which is mandatory, you cannot trade without a stop loss, this is my advice. To put your stop loss based on double top pattern, use the middle of this impulsive wave. Okay, so use the middle and then put stop loss around this area here. Similarly, if we're talking about the double bottom, you will use the middle of the new bullish impulsive wave and then you put your stop loss here. For the head and shoulders, the same. The last impulsive wave, you will use the stop here, and similarly to this here. Here it's more like the mid of the impulsive wave, maybe a little bit, 3/4 of it, like to the downside. In rising wedge, you will put your stop loss above the high here to protect yourself, and you can put for the falling wedge below the low of this rising wedge. So your stop loss is here, entry around the breakout here. Now we will talk about how to set price objectives or how to put your price targets using these patterns. We have seen stop loss, entry price. It's time to know where you should put your target profits. There is an easy way for these patterns, if we're talking about double tops and double bottoms, to know where you put your target profit. Let's say here your entry, stop loss around here, you should know now where to get out. There is an easy way. You will take the length from the top of a double top till the neckline, and you use the same length using the entry point. So if this is from here to here, AB, this target profit should be based on the length of AB. So this is equal of this. So this area here, the length is equal to this length. Okay, so this is where you should put your target profit. Okay, we took the measurement of the consolidation or the top of the double top until the neckline, and then we drag it till the entry price, and then you will have an idea where most probably the market will reach once we have a breakout here. Okay, so entry, stop loss, and target profit. You will do the same for double bottom. You will take the measurement from the bottom until the neckline and drag it until the entry price, which is here, and then you will have an idea where most probably the market will go to the upside, which is the same length of this one. This equal to this, okay? Stop loss here in case of this, maybe you can put it here under this low or under this low here. This is a real example on MT4. So to understand what's happening here, let me show you a real example, and I will show you another one on MT4 on the current data. So today's example. As you can see, the market was moving to the downside here, and then we have a bottom. And then the market rallied until this level and then moved to the downside in a way to break this previous bottom. However, the market failed. And then the market moved to the upside. So we have a double bottom, the first one and the second one. This shows that the market or the sellers could not push the market below this area, which led to a move to the upside. We have a close and a breakout here above the neckline. Remember the neckline, you will use this high to put your neckline, okay? This is the neckline of the double bottom. So once you have a breakout and a close above it, this is a confirmation that the market will reverse and move to the upside. If you would like to trade here, so you will enter around this area at the breakout at the close if you would like, or you can put a buy stop order directly here, a stop loss around this area here, and if you are a little bit aggressive, you can put it under this, which is risky. Let's move to MT4 to show you real life examples. An example of a double top. Double top here, you can see it. It's obvious. So the market was moving to the upside, higher highs, higher lows, and then posted a top that led to a move to the downside. So we have here a lower highs and lower lows. So this is the indication that the market could reverse. The neckline is here. Okay, I use this low or this low. Okay, I link them, and you can see once we have a breakout and close below it, the market move to the downside. So either you can put a sell stop order around the neckline, or you will wait for a retracement. So we had a slight retracement to the upside around this area here, which led to a move to the downside. Okay, you will use sell limit order here. Stop loss around this area here, like this. Stop loss here, entry if you would like here. Target profit is the length of the consolidation. So I took the top till the neckline and I will drag it until, let's say, this area. You can see that the market moves beyond this area. So it was better to enter on the break, which is around here, or you will put a sell stop order. And you can see that the market reached the target profit based on the consolidation, the length of the consolidation. Another example of a double bottom, let's say. Here we have a double bottom. You can see it. We have the market was moving to the downside, lower highs, lower lows, and then we have shift of direction. This is the neckline here. This is the neckline. So either you will buy at the breakout, or you will wait for a retracement or a correction. So here we have a retracement. You can see the long wick to the downside, or you can directly buy once we have a close of the current bar above the neckline, which is this one here. So you can wait until the breakout and the close above it, which is here, or you will wait until the market posts a correction and you will put here a buy limit order. So once you have a move to the upside, you put a buy limit order here, and then it will be filled once the market retraces to this area, and then you will be in a buy market order. Stop loss around here, this area, or if you're a little bit conservative, you can put it here. So yeah, this is mainly how to use reversal patterns. We showed you the definition, the 6 most common patterns. Hope everything is clear, and thanks for watching our webinar, and have a lovely day. Bye bye.